The definition of valuation is a member's opinion of the value of a specified interest or interests in a property, at the date of valuation, given in writing. However, in common practice, the word value is used to describe three related concepts: price, market value and worth. Price is the actual observable exchange point in the open market. Market value is an estimation of the price that would be achieved were the property to be sold in the market, subject to certain assumptions. Worth is a specific investor's perception of the capital sum that would be prepared to pay for the expected benefits to be produced by the investment. There is one internationally accepted definition of market value. It is the estimated amount for which an asset should exchange on the date of valuation between a willing buyer and a willing seller in a transaction after proper marketing where the parties had each acted knowledgeably, prudently and without compulsion. It is important to mention that not all transactions are after proper marketing, nor are all purchasers prudent and uncompelled. There are cases where there are special circumstances pertaining to a particular purchaser that would affect the value. Worth is the investment value of a property for identified investment objectives. It is an assessment of the liabilities of the property by an investor. It is the value in use, and since the benefit of the property will vary from one investor to another, calculations of worth require significant input from the investor in respect of their individual requirements and expectations. There is one internationally accepted definition of worth. This is called investment value. The ownership of property is separated from its use. As a result, price and worth must be applied to two interrelated markets: the market for investment purposes and the market for owner occupation. The price of exchange may be the same either for investment or occupation, but nonetheless the view of the two bidders will be different. An investor will view worth as the discounted value of the rental income produced by the property. On the other hand, the owner-occupier may see the property as a factor of production and assign to it a worth from the property's contribution to the profits of his business. There is also a view that there is no distinction between price and worth. A property is worth the price it can achieve if sold on the open market. Thus, worth must be the same as price. Assuming that there are no extenuating circumstances forcing an owner to sell, the decision to sell an asset will be triggered if the price in the market is equal to or above their valuation of the worth of that property to them. Similarly, all other things being equal, a decision to buy occurs at a point where the price in the market is lower than the investor's own valuation of the property's worth. It is important the information being used for the valuation is an indication of market figure and is not simply the individual view of the buyer according to his econometric forecast. If the latter were to be used, it would produce a calculation of worth to that investor and not the market value. This is the difference between an analysis of market expectations and forecasts to be used in calculations of worth. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.